When you have deposits in a fractional reserve scheme, you getting your money depends upon me not taking my money out.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Memorial Day through June 2nd, 2025, while supplies last. First this week, we featured 2025 1/10-ounce Gold Eagles at just $59.99 over melt. Next, backdated 1-ounce Silver Eagles are just $4.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this returning guest. Phil Lowe is the founder of The Bitter Draft. He's I would say genius at explaining things in common terms that ordinary people can relate to, and things not just in general, but about the financial end game and the times that may be coming our way. Phil, thank you for joining us this Saturday, May 24th, 2025.
My pleasure, Donnie.
We talked before we started this interview about three very important topics that we get asked a lot, and I'm sure you get asked a lot by people who are concerned about their family's financial future. One is, with the fragility of the banking system that we've been hearing about for the past few years, and which was also evidenced by some major bank failures in the U.S. and abroad, there's concern about getting into banks that are safe enough to maintain even just a modest amount of currency so that people can carry on their lives with some continuity. They wonder, should they get into the too big to fail banks, or should they ditch the banking system altogether and get into just savings and loans or credit unions as a way of protection? We'll talk about that. We're also going to talk with you about whether numismatics offer any advantage to people in truly end-time scenarios, financial end games, and if that's something that people should be taking advantage of or should be avoiding if they are trying to just take care of business for their family. Thirdly, how much physical silver is necessary to maintain your family's well-being in the financial end game? So if you're ready to roll up our sleeves and tackle these questions, we'd love to do it with your help.
All right, let's do it, Dunnigan.
So the first major topic there is whether alternatives to banks, and there's some reason for concern ongoing about for fragility of the banking system. Bank of America is one that's been identified as potentially a very weak link in the chain of interrelated banking systems, which is all existing in the huge shadow of a derivatives complex that could bring down the entire financial system, not just the banks. But there's interest in whether going to, for example, local credit unions might be a good safe harbor shelter to people in times of banking collapse. What are your thoughts on this?
Absolutely. So, and I want to start this off with a comment on my last appearance. We discussed the movie "It's a Wonderful Life" and how the banking system was operating in that movie. And it's a great reference for everybody because everybody's seen that movie, and it actually covers banking quite a bit, so we can chat about it. But there was a comment in the on the last video, and it goes like this: this guy is wrong about the Bailey building and loan scene. Prior to the Great Depression, 30-year mortgages did not exist. Buildings and loans were established in the late 1800s to help middle-class people afford homes. It works similar to a credit, where members were shareholders that received dividends for shares purchased, typically a short-dated loan of 5 years. New shares could not be sold until the old loans were repaid. This actually prevented bank runs because if everybody called in their loans, everybody's shares would be worth less and less. So when he says your money is in his house and her house, it was true. Potter, on the other hand, wanted to purchase all the outstanding shares so he could be the majority shareholder and would foreclose on all the houses. Hollywood actually got it right. This guy is a bozo. So, not just to defend my honor, which has been seriously damaged by this comment, this actually brings up a great point that I wanted to extend in and explain why, in fact, that the The savings and loan was not a good lending institution. So he is correct. Prior to the 1930s, prior to the Great Depression, 30-year mortgages didn't exist. And if you go back to 1910, people usually bought their houses with cash, which is astounding to you and me today to think, oh, that a normal person could just roll up with a bundle of money and hand it over and buy a house. But yes, that we were so wealthy at that in 1910 that it was well within the grasp of a prosperous working man who had saved to be able to save for 5-10 years and then get a house. Now, if this man, if he went to the bar after work every day and drank away half his paycheck, yeah, you're not going to get the house. But if you're prudent and if you're safe and if you work hard and if you work your way up into the factory or the mill or wherever it is you're working, you could buy a house with cash the way we buy a car today. And the other the loans that did exist were 5-year loans where you had, and with a 50% down payment. So even if you did have a loan, you had 5 years to come up with the other half of the loan for the house. So of course, once the Fed is created and starts cranking out the fake money, everyone suddenly becomes poor. And so people can no longer buy houses with cash after 5-10 years of hard work. So what does the credit industry do? They say, well, let's figure out a way we can extend them credit, and we'll give them 30-year mortgages. So now, instead of working 5-10 years and getting a house and having it and celebrating it with your children and your large family and living in it, now maybe you can own your house outright before you die. Right? That's the new American dream. So the credit unions were a function. They only were created once the credit bubble had begun to form by the Federal Reserve. They were not needed before on a sound money system. And the idea that if we'll give everyone shares in the company. So when you are a depositor in a savings and loan, you have shares in the savings and loan, and that's supposed to keep you from withdrawing all your money, right? And if you think about, let's go over to Mr. Potter real quick. Potter is the most greedy, money-grubbing man in town, but he would not loan Mr. Martini enough money to get a house. But why wouldn't he do that if he could make Mr. Martini a debt slave for 30 years, right? Mr. Potter, he's trying to enslave, in the confines of the movie, he's trying to enslave the town in his credit empire, but he wouldn't offer Mr. Martini the 30-year loan. Mr. Martini had to go to George Bailey. And the reason is because we don't know for sure because it doesn't show us, but Mr. Potter looked at the books and he said he either refused to offer Mr. Martini a loan. He said, look, this guy's not going to be able to pay me back. I'm not giving this guy a loan. Or the interest rates he came back with were offensive to Mr. Martini, who then turned around and went to George Bailey's savings and loan. So Bailey's savings and loan could offer lower rates because they were more leveraged than Potter, right? If you look at a competitive market, right, two banks competing, the only way to get an interest rate lower in a free market is to go leveraged, right? And that's fractional reserve banking. That's dangerous. That's when you get bank runs. So Bailey's was you're essentially, when you're going leveraged, you're essentially making up money you don't have and then loaning it out and then praying to, all that is holy that somehow that money is going to come back to you at some point. So Potter sensed this and was able to attack Bailey with a bank run. He was able to rouse the town up and say, Bailey doesn't have the money he says he has. And he was right? Bailey had to talk the crowd away. He had to talk the crowd down and say, no, the money's not here. It's in your house, right? That was his whole spiel. So when you have deposits in a fractional reserve scheme, you getting your money depends upon me not taking my money out. And in that case, Dunnigan, right, if your deposit account, which you have put your money in, depends upon me not taking my money out of my deposit account, then it's not your deposit account, Dunnigan. It's our deposit account, right? We now have a communal account. And I don't know about you. I like you, Dunnigan. I don't want to share a checking account with you. And I don't think you want to share a checking account with me. So we have to get away from this collectivist mindset that if we all chip in together, we can make this world a better system, or we can make a better system. We can't. This is the collectivist mindset, and your channel's name is Liberty and Finance, right? This is the most hardcore libertarian crowd of sound banking, sound money that's going to exist on the internet. So if I can't crack through to this crowd, that something like a collectivist pool of money where we all draw from, as long as we don't, as long as we all don't withdraw too much at one time, this is gonna work out great. We have to get past this mindset. Your money is your money, and my money is my money, and we cannot mix the two. Mixing the two is the road to perdition. But banks like to do it because if they make this collectivist pool of money and then loan out that same pool 10 times over, they can make tons of profits where that they could not otherwise make using an honest banking system.
Yeah, I have to interject here because that's a perfect segue into a concern that a lot of our viewers have and that we've shared for years. Andy Schechtman and others have shared on this channel, is about the pitfalls of fractional reserve solid money vaulting. So even if you own physical precious metals, gold and silver, but you store them in a vault, which practices this idea of pooled or commingled storage. It can be done in a completely legit way, but there have been some rather shocking scandals publicized by researcher and economist John Adams from Australia, talking about proof mathematically and through public-facing documents that some vaults have engaged in what could be called fractional reserve lending, in terms of that there's not enough metal on storage to satisfy everyone's withdrawal if they all demand it at the same time. And interestingly enough, the London Bank of England just recently had to extend their physical conversion or physical delivery time from the normal 1 to 2 days to 6 to 8 weeks. So there's a lot of interesting times happening right now, and that's something we've been warning people about for some time.
Yes, exactly right. And the way that scheme works is that, if you are a depositor and you're worried that your gold isn't there, you go and you bang on the door. You say, I heard you don't have my gold. And they take you into the room, they show you the big pile of gold on the table. You feel satisfied, right? And then you leave, and then someone else comes and they show them the exact same pile of gold, right? So everyone who comes in to say, where's my gold? They show them the same pile. But if everyone comes to take out the gold at the same time, it collapses. The savings and loan is exactly the same thing. It's just one derivative up. So, and the commenter made the statement that because the shareholders were the depositors, this somehow made the system more safe. It doesn't matter that the savings and loans were run by shareholders who were also depositors. If the money is fractionally reserve lent, then all lending institutions must also be fractional reserve or they die. Here is why. An honest bank must charge higher interest rates for its loans and must offer lower interest rates for its deposits. In fact, they have to charge you to deposit in an honest system. So if a bank with fake money is coming around or loaning out money they don't have comes into town, they can offer staggeringly low. I mean, if you're making up your money, you can offer really low rates. It's amazing how that works. So you can offer easy credit to absolutely everybody because you don't have what you say you have. So the entire town will flock to whichever bank is offering lower rates, and the only way for the honest banks to survive is to attack that bank and say he doesn't have the money he has and start a bank run. So now the commenter actually does have a point. Potter was also in the fractional reserve system. I misspoke in the last episode. I said Potter was on the gold standard. He wasn't exactly. However, he was less leveraged than Bailey's. Bailey's was much more highly leveraged than Potter, which is why Potter was able to attack Bailey's in the movie. Like I said, it doesn't matter if everyone in town is part of the savings and loan and we're all depositors and we all get together and we're all the nicest people in the world. If we vote to go fractional reserve, we've voted ourselves onto a Ponzi scheme, and it's impossible to vote your way into prosperity in general, right? What did somebody say? It's like voting is just two wolves and a sheep voting on who's having democracy is two wolves and a sheep voting on what's for dinner, right? So credit unions also likewise offer no in-game protection. And back to savings and loans real quick. All the savings loans went bankrupt in the 1980s. Why? Because they were massively highly leveraged, and then they got called out on it on a dip, and all the savings and loans went bankrupt. So the money wasn't there. it was not a good way to get people into houses with easy credit. It was a good way to get people into credit slavery. And debt really was treated as slavery for the longest time. I mean, if you go back to the Middle Ages or the ancient world, when you owed someone money, you couldn't pay him, you were enslaved to him. The English word was a bondsman. You were his bondsman. And until you paid off that debt, you had to tend his pigs, or they'd put you in these humiliating jobs where you had to tend the pigs or collect the garbage or whatever. You had to do these jobs to work off your debt. We got away from that in the modern age, but debt really was looked upon as something to really, really be avoided in the past. Anyway, credit unions likewise offer no in-game protections because they're also on the fractional reserve scheme. Right, so it doesn't matter that they're not the big banks. The money itself is fake. So it doesn't, I should say, the thing we are using for money itself is fake. So it doesn't matter if the most honest, whatever scheme that's using the fake money, it doesn't matter how honest or forthright the bank manager is or the board of directors. It doesn't matter. They're using fake money because they have to, and they don't necessarily understand that they're using fake money. I understand that. I'm not saying everybody in the banking system is a cackling evil genius trying to extract wealth. They're in the system they're in, and they're trying to make the best that they can of it. And the system requires easier and easier and easier credit to trap more and more and more people into debt slavery until it blows up. So there may be some, I don't want to, because it's a common refrain among the space to get your money into a credit union or get your money, into a small local bank, stay away from the big boys. There's no in-game protection at all from this. However, there may be some in-game benefits for using a credit union, particularly if you are a social dissident. So if you're someone who, doesn't speaks out against the government or speaks out against certain ideas or certain things, you're at risk of being debanked from larger institutions who are trying to stay in the good graces of the shadow evil empire that rules over us all. So in that case, you may be better off in a credit union that's less likely to debank you. But in terms of surviving the in game, there's nothing there because the money that's deposited into the accounts is fake and is going to blow up just like every other bank's. So if you're worried about the in game, it's better to stack. So in a larger context, there is a place for credit in this world. There's always been a place for credit, but it's very dangerous, and it should always be carefully considered. And anyone offering you easy credit is not your friend, right? Credit is a slavery device. It can, if you have a business idea and you want to expand upon that business idea and you need credit to launch this, and you're very confident it's going to be successful, then sure, take the risk. But in terms of the world we've lived in for the past 100 years has been one of extremely easy credit, and it's given us all very bad. It's adjusted our behavior into very negative ways where we're used to just free credit sloshing around, and we get ourselves into all kinds of trouble over it.
Your comments about bank leverage is echoed by our guest who's frequently on, Alistair McLeod, a former bank director, who talks about in this era that we've been in for 40 years of declining interest rates, there's been so little comparative yield available for banks to make their nut than they maybe could have in the past, that they've had to gear up their leverage. Japanese banks in particular are notorious for being up in the 20s or more times what's on deposit than what they have loaned out. So it means that if their investments, if they have toxic loans, things that move against them by even 5% or so, if you're 20-to-1 leverage, then you're insolvent. And that's one of the grave concerns that have people worried about such places as Bank of America, and that caused, frankly, in 2023, the second, third, and fourth largest bank failures in the U.S., not to mention Credit Suisse in Switzerland and others. So it's a serious concern. And you also brought up in the discussions that we had prior to this interview about numismatic or collectible coins, why some people believe that will protect them from the risk of government confiscation, or just be better than having standard bullion in the case of the end game. Your idea is that that's only for collectors and not for ordinary stackers. And that's something that a lot of moms and pops have become subject to if they're pressured by some dealers into upselling or overselling, overbuying and buying much more expensive things than what they would need to just to protect themselves. Your thoughts on that?
Sure. So the money is a commodity. That's the definition of money is the most liquid commodity in a market. And if you go back to the ancient world, the pre-civilization, money was, heads of cattle. And then later on, it became rice and barley, could be money, or salt. And once metallurgy really came into fashion, gold, silver, and copper became the money. And it's just the most liquid commodity in a market. And commodity, the definition of a commodity is that they're indistinguishable, interchangeable within the commodity. So if I have a bag of rice, each grain of rice is completely interchangeable and indistinguishable from any other grain of rice within the bag. Now there are different kinds of rice. There's basmati and short grain and long grain, right? And those are different between each other. But within the bag of rice, there's no difference, and you don't sit there trying to look for the good grains. They're all completely indistinguishable from each other. So when you can owe someone a gold coin, like a gold coin, I took out a loan, I owe you a gold coin, but you can't owe someone a Picasso, right? You can owe someone a specific Picasso painting, but we can't have a contract where I owe you a Picasso, just some Picasso. And if we did, I would find the absolute cheapest Picasso I could find. And I picked this on purpose because Picasso was one of the rare artists who lived into his fame. He didn't die before he became famous. So at the later years of his life, he would go to restaurants and he would eat, have a nice meal. And then when the bill came, he would take out a cocktail napkin and he would doodle on it. And he would offer that in payment. He'd sign it Pablo Picasso, and he'd identify himself on Pablo Picasso. I would like to pay for this meal with this painting I have just drawn. So there actually are, and he did this a lot. So you can, as long as you're willing to deal with a cocktail napkin, there are plenty of Picassos that are in the range of a normal person's budget if you want to collect a Picasso. But my point is, if you and I contracted for a Picasso and you were expecting one of his famous paintings, and then I show up with a cocktail napkin that he doodled at a restaurant in 1970, you would be very disappointed. So nobody makes those trades.
I want to interject one more time that this exact phenomenon happens in the world of precious metals as well. If you have a pooled or commingled account, or even if you have an account that is not segregated at a storage place, I'm going to go cheap. They give me free storage, or they give me almost free storage. We've had people who, for their IRAs, for example, bought brand spanking new Royal Canadian Mint stamped, shiny, mirror finished 100-ounce silver bars. And when it came time to take a physical distribution from their IRA, the vault dutifully shipped them the most ugly, beat up, tarnished, nicked, and cats and dogs. Well, there's other things people call them, types of 100-ounce bars. So fungibility in terms of indistinguishability between them is something that is not necessarily the case. So if you want your stuff to be your stuff, it better be segregated from anyone else's stuff and not commingled. Go ahead.
Exactly. So when you're dealing with a commodity, right, you're dealing with something that's completely interchangeable, like you just pointed out, right? They owed the depositor gold, so they gave them the most raggedy gold they could find. Now it's still gold. That gold has its monetary value. They didn't lose the monetary value, but they put in gold with artistic value on top of the monetary value, and they did not get that back. So numismatics are works of art using money as the artistic medium. So to take another example, right? If I have a bag of basmati rice and I make a 1/1000th scale Taj Mahal out of that bag of rice, I sit there and I painstakingly craft a replica of the Taj Mahal, and it's big and it looks amazing. The underlying commodity is still the rice. Now I can go to an art collector, or I could go to an art museum, and I could say, look at the work of art I have done. I have improved this rice by putting my labor into it and making an artistic medium out of it. And look at the beautiful work I have created. You should pay me more than the cost of the bag of rice, and to purchase this from me. And maybe they will, and maybe they won't. That's that artistic value is entirely subjective. I mean, somebody just paid $60 million for a banana taped to a wall. So who knows in this day and age? But the numismatic coins are works of art that are using gold as the or silver as the monetary is the artistic medium with which to construct it. So they take a round, and then they stamp it, and usually these things are proof, so they're in very fine detail, and you would never circulate. This is not a typical circulated coin. This is something that you want to put on your shelf and display to your friends. And there actually is a market for collectors for numismatics. Mario Aneco's friend Clive collects, I can't remember which year, but he collects some of the British Royal Mint coins. And I'm sure there's collectors for all the different ones out there. And you want to get the whole set. Usually they make, 12 different coins. And it's usually, the Goddess Britannia riding a unicorn, and then the Goddess Britannia slaying a dragon, and the Goddess Britannia, or it's the lion and the unicorn, obverse, facing each other, all the different things from heraldry and Great Britain's past. And there's a market to collect all of them, and I'm sure the wealthier among us want to collect all 12, and they want to display it on a shelf. And the friends come over and they say, "Wow, those are really beautiful. It's really neat that you have those," and they get jealous and want them their own. On top of that, on top of the collectors, there's a market of speculators, and the speculators have no interest in collecting it themselves, right? They're just say they could care less. They can barely differentiate for themselves. They would barely differentiate between the proof and the bullion. However, they see that the collectors are offering premiums, staggering premiums for the numismatics, so they grab the numismatics thinking they have an arbitrage opportunity, that they can buy it at a certain price and sell it to the collectors at a higher price. Now, disreputable IRA dealers use the speculative price pump to say, see, there is a demand for the numismatics for the monetary, above monetary gold, right? There are collectors who are paying extra for this, so you should put this numismatic into your vault. The problem is it's really impossible to tell who is a speculator and who is a collector. And if the market is if it's 90% speculators, then what you have is a classic bubble. It's like Beanie Babies. Everyone bought into Beanie Babies thinking that there was someone else who's going to pay more for the Beanie Babies. And so this, the speculative bubble, grew and grew and grew until one day it popped and, turns out there's nobody in the market for the Beanie Babies. So there's probably not most of the pump for the when the IRAs come to you and they say, these coins are worth this much, most of that is probably just other people who are getting suckered into IRA speculations, or rare proof coins that the IRAs are pumping up to try and get additional, because they're getting additional revenue by selling these rare coins rather than just straight up bullion. So if there's very few end users for the numismatics, you're not going to get, at the end of the day, you're probably not going to get what you thought you were going to get for those coins. Additionally, if you're prepping for the end game, and I think most of the people in this channel are, thinking about the dollar end game and they're preparing for that. The monetary, in an end game, when the credit bubble blows up and everyone's scrambling for money, the monetary value of the coins and the jewelry and anything with gold in it. Because remember, gold itself is the money. Doesn't matter what shape it's in. So necklaces have money in them. Jewelry has money in your watch, your earrings, the coins, the bullion. They all, if they're made out of money, if they're made out of gold, they have money in them. The monetary value skyrockets to unbelievable proportions, and all other considerations are usually abandoned. And this is evidenced if you watch what happens in a hyperinflationary event or a deflationary crash when people are still scrounging for money the other way. If you see what happens, either you watch the movies of the Great Depression or you go to see videos out of Venezuela, what are people doing? They're taking their necklace and they're clipping it because the necklace itself is so valuable, they need to chop it into little bits to go get a haircut or buy some food, right? So they they chop each little tiny chain off the necklace and they bring it in. That has destroyed the artistic value of the necklace. Whatever value that necklace has beyond its monetary value is gone. Same thing with a numismatic coin. If you take a numismatic coin, this one coin might buy an airplane or something, or a car. I was thinking a Cessna, not a large airplane, but this small coin might buy, it is staggering amount. So what do you do to get a haircut? You have to shave off a tiny little bit with a razor, and that of course absolutely destroys the numismatic value, because especially for modern coins, they have to be absolutely pristine to have the numismatic value because a collector doesn't want them for anything else. Now, an ancient Roman coin gets a lot more slack. If you can see the face of the emperor and you can read the text on top, you have a pretty good numismatic coin for an ancient Roman coin. But for modern coins, they better be pristine if you're going to try and pass them off to a numismatic collector. So there's very little mercy for rare coins. In a monetary panic, there's no mercy for rare coins and jewelry. They just get melted down or chopped up into little bits and used to purchase the goods and services they need. Now, on the other side of the panic, the numismatics that survive this might be worth a lot more because 98% of them got melted down to turn into new coins, or cut up into little bits to trade around. So you'll still have money in such a scenario, but you will have overpaid for it in the pre-crash. So I do want to comfort people. I know some of your viewers have contacted you saying, I got swindled by the IRA dealer, and I ended up with a third less gold than I would have had. The monetary value of the coins you do have absolutely still will skyrocket along with the rest of gold. And you're one of the, I think, how many people have gold in their savings these days? It's like 1%, maybe less. So you're still going to be in the top 1% of money holders in the middle of a financial panic. I do want to give you some comfort there. You're probably going to be doing just fine. It's annoying and it sucks for people who have been, swindled into numismatics if they didn't want to get into them. You might only get like a single Cupid fountain in front of your mansion instead of, the three Cupids facing against each other. But most people holding gold are going to do quite fine. And I don't think you should kick yourself too much if you got taken by a numismatic dealer and you regret it. And so just to conclude this, numismatics are for collectors and active speculators. So if you want to play the game, that's fine. But if you're just somebody who wants their money to sit in a vault, then I would strongly, strongly recommend everyone just stick to bullion.
Yeah, that's one of the things that we talk about with our clients, and that is there's nothing wrong with numismatic coins if you can get them at the right price, but don't be pressured into overpaying, paying 50% or 100% more than the price of the bullion with the idea and the hope that that's somehow going to protect you. But if you can get them at roughly the same price as bullion, and there may be during civilized times, either before or after the end game, a time when those numismatic premiums return, that pumps up their value in the free market relative to non-numismatic forms of bullion, then you might come out ahead from a trading standpoint. But that's, again, you said it may be good for speculators or traders, people who want that option, but don't be pressured into overpaying for that and cutting your nest egg in half. Phil, you also talked about how much silver, and this question gets asked a lot by people, how much silver is needed for people to be prepared for the financial end game. You have some opinions about that.
Yeah, I get this question at least once a week, and I guess you get it a lot too. People say, "Okay, Phil, I understand we want, more is better and stuff, but what should I look at as the base? What is it I need? How much do I need to get my family through? And then everything else, I would consider gravy on top to purchase assets, right?" So I finally sat down and just said, let's try and calculate this out through intellectual, logic and using history as a guide. So the daily wage of a laborer in 1910 was $2, $1.50 to about $2. We're going to say $2 for simplicity. And this was a guy, straight off the boat at Ellis Island, living in a tenement in New York and working in a factory. He could expect to make $2. That's the lower base pay of just, mindless labor. Here's a hammer. Here's 1 million widgets, and the widget comes on. You go tunk, tunk, tunk. Unskilled labor. What are they going to get paid? They got paid about $2 a day. And if you calculate that into silver quarters, it ends up being about 1.45 ounces of silver. So the silver quarters at the time were 90% silver. However, 4 silver quarters does not equal 1 ounce. It equals about 0.72 ounces of silver. So if you double that for $2 a day, you end up with 1.45 ounces of silver. And then, so a daily laborer in 1910 worked about 300 days a year. So that's 435 ounces of silver per year. Now, this salary would feed, clothe, and house a family of 8 at survival levels. This is the pictures of the tenement. You go into the tenements, they would take pictures of people in the tenement, and there's like 8 people in this tiny flat, and the younger kids are clearly wearing the older kids' hand-me-downs, and the older kids are wearing dad or mom's hand-me-downs, but they are fed and they are living, right? They're surviving. This is survival levels. I'm not talking about having tons of extra money. I'm talking about living at survival levels. You could feed, clothe, and house a family of 8 on $2 a day. So most people today don't have 8 family members. So we're going to cut that in half to family of 4, and we're going to double the comfort. And that, I think that's going to cancel each other out, because if you have half the mouths to feed, half the feet to shod, half the everything else, right? And if you think about this, most financial panics last about 3 to 6 months. So we don't need 435 ounces for the year. We only need 3 months worth. So in conclusion, to the end of the calculation here, about 100 to 200 ounces of silver should get a family of 4 through a panic relatively comfortably. And that's about 25 to 50 ounces of silver per person. And this will cover everything. This will cover the haircuts. This will cover the food. This will cover the heating, the heating bill when the electric company bangs on your door and they need payment in silver. This will cover absolutely everything. And it should get you through, if you think about 25 to 50 ounces per person, I think that should get you through quite comfortably through the length of the monetary panic of 3 to 6 months. So there's some other considerations. There is very little silver in circulation today than there was in 1910. In 1910, silver was flying around all over the economy. Now it's just a handful of stackers. So that should make silver much more valuable than it was before. So you may need a lot less. And there's also many, many, many more people alive since 1910. I think it's a factor of 10. I think there's 10 times more people than there were in 1910, maybe a little bit less than 10 times more. Once again, if there's more people competing over the amount of silver and there's less silver available, that should once again make silver even more valuable. And third, the numbers I used above assume a normal life, not a banking panic, right? So in 1910, there was not an ongoing banking panic. I guess there was recently. I think there was in 1907. Was that the last banking panic? I think there was somewhat recently, but I believe 1910
through the late 19th century and early 20th century.
Yeah, okay. But I believe 1910 itself was a stable period. So I'm not assuming skyrocketing monetary value. I think that was a normal economic time within a period of banking crisis around that time. So the numbers I'm using above are assuming normal life, not a huge banking panic. So once again, if there's a monetary crisis, the people holding money should be sitting very pretty. And then so silver could dramatically outperform the expectations mentioned above. So it could be 10 ounces of silver is enough to get you through a financial panic very comfortably. I don't know. I'm being very conservative with my estimate. I think 25 to 50 is very, very conservative. The one possible exception I'm thinking of is if things really start breaking down. So if the farmer puts the food on the truck and the truck starts to head into town, and then some highwaymen come out and they kill the truck driver and they loot the truck and steal the food, and the food trucks are not making it into town, then in the town you live in, if that town is, if that's affecting you, prices of food could absolutely skyrocket even in real terms, because your town is essentially under siege. So if you look at what happens in the Middle Ages when a town went into siege, people would mortgage their house or sell their house to get a bag of flour, that kind of stuff. So that kind of thing could happen. I'm not saying it's going to happen. If because of Maslow's hierarchy of needs, right? What do we need? We need water, food, and shelter, and clothes. If those things start breaking down, they're going to become very expensive in real terms. However, if this just stays a monetary panic and we don't get into a situation where you can't drive on the roads because there's too many highwaymen, and I think in particular in America, everybody is so heavily armed that highwaymen are going to have a very bad time of it if they try to take over a highway. I think the townspeople are going to go remove those highwaymen. So I don't think we need to worry about highwaymen too much, or the network breaking down to the extent that I'm talking about, like a Mad Max scenario. I really don't think so. So barring that, if all the other stuff I'm saying is true, and even if it's not true, a conservative estimate, in my view, is 25 to 50 ounces per person. I was talking with Rafi about this on his channel. He says double or triple that just to be extra safe. So sure, have 100 ounces per person. I mean, what's 100 ounces? $3,000? If you can put $3,000 into insuring per person to ensuring your family is, comfortable through the end game, that's wonderful. And then if you don't need it, then you can use that money to buy the Lamborghinis and the airplanes and the factories and the farms all around you and turn into a gentleman of considerable property. So
I would agree with Rafi that one of the things that a lot of Americans have to deal with is if they have a home that's considerably larger than a 1 or 2 or 3 or 4 bedroom flat in the tenements, they may have a mortgage on that and that hanging over their head, the debt on that. So even if they lighten up on getting rid of the second car and cutting some frills and that sort of things, this just to support any kind of continuity of their life, it would probably take significantly more than what would otherwise if they didn't have those obligations. And this is one of the things that we talk about often with people when they call up and ask how much junk silver is it necessary for me to have and that sort of thing. And we talk about it in terms of, they are experts on their family's outgo. So if you think about what it takes to maintain your family's lifestyle for a month, what if you had to pay all of that with cold hard cash, meaning real money, that gold and silver? And you can just say, well, how many months do you feel comfortable having in your emergency rainy day money drawer? 1 month, 3 months, 6 months, 12 months, 24 months. It depends on the individual, and they can come up with a good answer. But think of it from a time basis of maintaining your family's well-being, keeping the ship upright for how long is a good way to approach it. Phil, if people want to follow your work, because you write about and do videos about, I will say, many, many topics like this that make them accessible for ordinary people, where should they get connected?
Sure, you can reach me on thebitterdraft@gmail.com to contact me directly. And I have a Rumble channel, The Bitter Draft, and that's the old spelling of draft, DRAUGHT. And I also have a YouTube channel, but I prefer people come to Rumble if they are available, if they can. I was speaking to some viewers who said that Rumble is banned in their country, so they had to use YouTube, so that's fine. I have YouTube up for those people. And then I also on X at The Bitter Draft again.
Well, Phil, we're grateful for your presence always here on Liberty and Finance, and thank you for joining us.
Thank you, Dunnigan. Take care.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for Memorial Day through June 2nd, 2025, while supplies last. First this week, we featured 2025 1/10 ounce gold eagles at just $59.99 over melt. Next, backdated 1 ounce silver eagles are just $4.79 over spot. And finally, constitutional 90% silver dimes and quarters are just $1.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.